Okay. Thank you for joining today's workshop on setting the role of the safety net through people's self-assessments of their financial well-being, hosted by the Consumer Financial Protection Bureau. My name's Devin, and I'm a member of the Academy staff. Because we're a small group today, we'll use the chat box for questions, and there will be pauses in Hector's presentation to allow time for discussion. At the close of this workshop, you will receive a follow-up email that will include a feedback survey, including questions about this workshop. Please take a few minutes to complete this at your convenience. And I will hand it over to Hector now to get started.
Hi, good afternoon, everyone. Thank you for joining us today on this conversation on the role of subjective measures in terms of helping us understand the experience of economic insecurity and security, as well as the value of taking into account people's self-assessments of their own financial circumstances. I think it will be, given the small size of this group and the scope of today's conversation, I invite all of you to, if you're in front of your computer, which I imagine most of you are, or in a tablet, and you're able to look at the link that I'm sharing with you here. And if you're interested in taking a quick look, I will give a couple of minutes to all of you to look at the financial well-being score in scale, just as a conversation started. I don't want to sort of give a preconception of what it is and how it works. And I know that after the workshop today, we're going to have a great conversation. I just want to say a few things. It's voluntary, it's anonymous. We're not collecting any information even as part of that session, and we don't save that data. And we're not asking any specific personal financial data. These are all types of questions that you answer with a scale type of answer. So I'm going to give you a couple of minutes. If you have a chance to look through the questions, if you want to answer and get your own score, you're welcome to do so. But this will be a very helpful first step to today's conversation.
For those just joining, please view the chat box for the link to the Financial Wellbeing Scale user guide that Hector's encouraging participants to look at for a few minutes.
I am very sorry. I don't know what happened. I got kicked out of, can you hear me now? Yes, I got kicked out of
Yes, I can hear
Slides. I'm glad that this is a relatively small audience and
you.
hopefully a friendly one too. I'll share again the slide and then we can move forward with the actual presentation. Apologize again. Great.
And Hector, were they clicking on the link in the first
It was the
slide or
it
the?
was the slide. I apologize. Okay. I realized after I saw the chat that that is actually to the development and how to use the scale. It was the more straightforward consumer finance, financial well-being, and we will have a chance to talk about the scale. It was just as an opportunity for people to see the actual questions and to sort of see what this measure is about. All right, so again, good afternoon, everyone. Thank you for joining us today on this conversation about studying the economic security and the role of the safety net through people's self-assessments of their financial well-being. I want to thank NASI again for the opportunity to present. I have a long history with NASI, great organization, great commitment to economic security issues and understanding how fill those gaps in the safety net again that protect individuals in the United States. I'm a senior policy analyst at the CFPB, Consumer Financial Protection Bureau Office for Older Americans, and I lead the agency's financial well-being work. As many of you are familiar with the CFPB, you probably know us as a regulator of the offering and provision of federal consumer products like mortgages, credit cards, student loans. But in addition to those responsibilities, we have a financial literacy as well as financial research, consumer financial research mandate. And under this mandate is that we conduct research on the drivers of financial well-being from policies, programs, as well as behaviors that are conducive to both maintaining, protecting, and increasing financial well-being. Before I share with you the work, I also want to disclaim that even though I'm representing the agency today, I may state views and opinions that are not necessarily representative of the Bureau's views. Today, I'm going to cover a few things, and one of those are I'm going to go through a definition and measure of financial well-being. I'm going to go through how it varies by different demographic segments and how it relates to traditional measures of economic security, primarily income and income credit scores, but also look at savings. We'll also be looking at how financial well-being changes over time and how it's related to some of the risks that the safety net is intended to protect people against. And again, we're going to look at some COVID-related risks. So what is financial well-being? I know this is a very trendy concept for many of you. It just sort of comes in other words like financial wellness or financial health. The measure itself and the concept, it's gaining a lot of traction and attention, and largely it's because there's an understanding and an increasing recognition that measuring holistically people's situation is valuable, as well as their satisfaction with their financial situation. So to learn what financial well-being means, we interviewed consumers around the United States. We covered the age ranges of ages 18 to 95. These were open-ended, in-depth interviews to understand the concept. And what we learned is that, here is the definition of the slide, is that is the state where a person has the ability to meet current and ongoing obligations, has a feeling of security in their financial future. And that means both being on track to future goals, but also being protected against a financial shock. And then lastly, their finances allow them to enjoy life. So you can see that there's both an element of security and an element of freedom of choice, both in the present and the future. Particularly the element of security is both on the ability to meet ongoing obligations, meet basic needs, and then on the future, if something happens to you, car breaks, house, have a natural disaster or other sort of risk or shocks, you're protected against those. Those elements came across a variety of groups, a variety of geographies. It was pretty consistent. The exact sort of things that were related to it were in some cases so individual, but the themes again were pretty constant through different groups. As you can see, there's an important element of subjectivity here. People want their finances to allow them to do the things that they enjoy, they like in life. And so to be able, again, to capture that and do so reliably in a way that you can compare people and measure it across time is the challenge. So to do that, we engage in a scale developing process. I think that was the right approach, given that we're dealing with a concept that has multiple dimensions, including dimensions that are inherently subjective. This is the scale. It has 10 items. We have a shorter version that only has 5. Many surveys have fielded that particular 5-item scale. This scale that you see here, as you can see, has questions that everyone can answer. You don't need personal data. Certainly, again, that include elements of subjectivity. And we have, again, we spend a significant amount of resources to both validating, testing it with a large group of consumers. So the scale is as good also as the scoring. So we also engage in a scoring process that we felt was important to also provide us with enough variation, but also with the type of scoring method that allowed us to reliably measure this and compare individuals. And we ended up with a scoring method based on item response theory. So it's very similar to SAT. It's also standardized. It's a number between 0 and 100. One of the underlying properties of the IRT score is that instead of just us assigning a weight to the values based on our own sort of expertise or perception of what's important, it is actually how people answer the items, the difficulty of answering the items that sort of generate the relative importance of, for instance, moving from an answer that says never to an answer that says sometimes. And that's pretty much what this underlying method, again, I'm simplifying it, and I know some IRT experts may be horrified by from the way I'm describing the IRT scoring, but the one thing that I want to say, this is not an A to F method. So A is not here 90 to 100. In fact, again, because we normalize this at a 50, it follows more a bell curve where like it's pretty sort of rare to find cases in the two extremes, in at least in our population. And we have 2 adjustments of the score. One is by how the scale was administered, so whether you took it yourself or someone read it to you, and then the other one is by age group, so a different sort of adjustment for those who are 62 and older. The scale is being used by many organizations, has been fielded in Brazil, Norway, Canada. The OECD administered it to over 10 countries, so we have a lot of comparisons internationally too. Right. So we also have spent time doing some benchmarking for the scores and what's very low and what's very high. We know that if you can think of any particular experience that that goes with financial insecurity, from being rejected to credit to being debt collection or bankruptcy, those probabilities on those negative ones decline consistently across all of these dimensions, the categories. And here's just a quick example of that. So for instance, being contacted by a debt collector, you sort of see a decline. And I mean, you could be contacted by a fake debt collector. So you could also have people accounting in those categories. But you can see, like, pretty much once you get into the very high and the high categories, it's a pretty universal level of economic security. While like those in the low and very low, they're pretty decent percentages of those groups who are experiencing basic material hardships. And we have other questions. These are just some examples of how it relates to factual things. We have done more work on sort of validating it against actual experiences. And we know that if we created an index of about 15 factual hardship questions, we account for almost 80% of the variation on the financial well-being index. But there's still a 20% variation that could be a variety of things, from expectations to people's satisfaction, but also could just be measures that are not being accounted for. What I do want to sort of warn everyone is that because this is a holistic concept, we can have two people getting the same score, a score of 50, for example, but they get there through different paths. You can have someone who has a score of 50 because they have a very positive outlook in the present, but they're very concerned about the future. And that's usually the older population. They're concerned about running out of money, about not being able to do the things that they enjoy financially because of the future risks. On the younger side, you see more like struggling in the present, but they have a very bright sort of view of like where possibly their income will be in the future. And so again, they both get a score of 50, but they came to the same score through different sort of circumstances. So I'm going to go now through a couple of slides that will give you sort of a sense of what that looks in the US and how it relates to a couple of factors that you're familiar with. So to do that, we did a survey in 2016. It was a pretty comprehensive survey of asked a bunch of questions, and I'll get to more recent data, but this is sort of the foundational of the work. And as you can see, the average financial being in the US is 54, sort of locating us at the sort of medium-high category. And when you compare this with other countries like Canada, it's a little bit above the US for about the same period. And then countries like Brazil are more into the medium-low category. So definitely you see consistently in countries by development in that sense. But one thing that I want to point is that, you have here about 11% of the population have low and very low scores. For that year, the poverty rate was about 12%. So we're not that far from the actual experience of poverty as measured by income. And as you recall by some of the distributions, the individuals in the low and very low categories do experience pretty frequent material hardship. I'm going to go through quickly some of the demographics. As you can see here, they all vary as expected. It goes up with age, and it starts declining at the oldest segment of the population. There are differences by race and ethnicity. White non-Hispanic have higher financial being than Black and Hispanics, and as well as other groups. What was sort of more surprising to us is that those differences were not as big as the ones that we have observed in actual data in terms of income, of course, and wealth and net worth. And that we had a very similar score for male and females. Now, more recent surveys have found slightly higher financial being for male. but just a 1 point difference. So we're still not seeing a major significant difference between those two groups. The next set of slides, I'm going to talk about the relationship with the score with various measures of traditional measures of economic situation and assets. And so one of them is income, and you can see that financial being the average, which is that line, the black line, increases with income. But there are huge variations at each income level and a lot of overlap between the entire distribution. The thinner bar represents the 10th all the way to the 90th percentile. So again, you can see large overlap between those. Those variations could be explained by so many things. Income can be put in context of expenses, can be put in context of, family size. And so none of those are being accounted here for. And so we, again, didn't found a strong relationship with income, but not perfect. So, and not surprisingly, poverty level, which is sort of an equal measure derived out of income, shows a similar pattern. Here it's actually even more interesting. And as someone who worked on access to benefit programs, this didn't surprise me that there was such a overlap between those below the 100% of the FPL and those near poverty. And that is because one group has the entire, primarily access to an entire safety net, and another group doesn't. And so there's a lot of overlap here that could be explained by that. And when I was working on a lot on Medicaid access, I could tell you a lot of people were just better off having a few dollars less and being eligible for Medicaid than having that extra income. The other thing that we find is that financial being does vary by liquid savings, and it's probably one of the strongest associations in any of the research we have done. One of the strongest relationships with financial being is savings. In liquid savings, it's just not just simply because you have savings, it's also, it has so many ways in which it's associated with well-being. One of it is, the fact that you're able to save, it means that you have a positive cash flow that allows you to do so, and most likely you don't have any of those experiences of being late in payments, etc. The other thing is, if you can think of the dimensions of financial well-being, from enjoying life to being able to being on track to a financial goal, which usually for people meant buying a new car, buying a new home. All of those things are so closely related to savings. And again, this is sort of a straightforward relationship. What it's nice about this is we are quantifying those relationships. And lastly, we had a project where we worked with Credit Karma, where we were able to sort of look at the relationship between the financial well-being scores and people's financial well-being scores. And as you can see, financial well-being scores increase with credit scores. And we have done this also with a representative sample of those who have credit records, and the same relationship appears here. It's a strong relationship, but again, a lot of variation at each level. Do we have some questions at this point, Devin?
Nothing yet, unless folks have anything they want to drop into the chat for me to share with Hector. Let me know.
But I'll move in, and I can certainly stop if something comes in, Devin. All right, so I'm going to talk a little bit about how then this measure sort of tells you something about disparities and potential inequality. As you saw, it's very related to economic security measures like income but I will show you that it's important also to measure disparities in how people feel about their finances. You recall this graph before, and it just showed relatively small differences by race and ethnicity, and pretty much no difference by sex, and certainly differences by age. But if we were to cut that data differently by looking at the financial well-being scores by groups and then by age, a pattern becomes pretty distinctive here. And that is that it looks like there's no differences on the younger segment, and those differences start appearing and in many cases becoming statistically significant at older ages, and particularly the differences between racial and ethnic groups. Similarly between those who are married and not married. The differences by sex are also statistically significant, but as you can see, there are only 2 points here, almost 3 points actually. But the most significant one, again, is the racial differences are more stark at older ages. And what's interesting is we see this not just when you cut it by race and ethnicity, you also see it when geography also it's looked through in this analysis. So what we find is, and this comes from FINRA, they use a sort of a different survey methodology, which sort of led to slightly lower average generally. But sort of the patterns are what matters here. And they have state level samples. And as you can see, the average for the US is 52. And what they found was that there was very little differences in the average by state. Only 7 states had statistically different averages. And as you can see, the highest ones are California, Hawaii, and DC. The lowest ones, Louisiana and Mississippi. But there was a lot of variation in every single state. But what was interesting was that when we looked at the difference between the 90th and the 10th percentile, the score for those for the entire adult population by state, we found that that varied much more by state. In the US, the difference between those 2 percentiles was 43, but in places like Kentucky and Missouri, it was 47 points. In Michigan was the more sort of equitable state with only a difference of 39. And this is for the entire 18 and older population. But once you look to the older segment, that's again when you see the big differences in financial well-being scores. And you have states with like Tennessee and New Jersey where the difference between the 90th and the 10th percentiles is 55 points or more. And you have a state like Hawaii and North Dakota where there seems to be a more equitable sort of experience of financial well-being. Lastly, I want to sort of talk about the not just sort of variation looked at a cross-sectional or from geography standpoint or groups, but also looked at the value of the scores when examined over time. And I have to say, you know, a lot is going to come in hopefully in the next few months about this as surveys have been conducting, have been administering the scale over the COVID period to individuals and seeing how it changes over time. But we have learned a lot about how the scores change over time and what's associated with a small and large change in scores. And this was a 2018 to May 2019 changes in scores. And as you can see here, this comes from the University of Southern California online panel. They found that the financial well-being generally increased by 1 point between those 2 years, but that there was a very wide variation in how people experience it. About 50% of people only had a change between -4 and +4 points. As you can see, 19% only had between -1 and +1 points. Again, the majority of the people had a positive change, and that goes with the economic growth between those 2 years. But as you can see, there were segments of the population who had a negative experience during that period. And what they did was, as part of a study that we commissioned, they looked at what was associated, what kinds of financial shocks were related to explain those changes in financial well-being. And what they found was that the 4 on the bottom here highlighted were the ones that had a statistical significance and predicted those changes. And they were the ones with pretty large occurrences. At least 10% of people experience those in the year. The death of a family member, which is one of the other large ones here, didn't, directionally, all of the others were as expected, but they didn't, I guess the variation was so large in all of those experiences. And part of it is they didn't account for the role of insurance in each one of these categories. But as you can see, the biggest 2 factors here relate to job-related experiences, and the other one will be a medical expense. But the one that particularly related to a swing of 10 points or more were job-related shocks. And that sort of brings us to a very important conversation today, because we are dealing with a pandemic that not only addresses, that targets those 2 issues, for some a major medical expense, but primarily for Americans, a job-related sort of impact, and how the government has certainly responded in terms of getting access to both enhanced unemployment insurance, but also forbearance and other responses. But one of the things that we learned from the research of Burke and Perez Arce using the financial well-being scale was that there was a limit to what people could do through behaviors. They looked at, was there anything, did having a manageable level of debt matter? Did planning ahead matter? Did saving in liquids matter to sort of mitigate the sort of the negative effect? Did spending less, was spending greater than income related, or was saving for retirement mattering here? And what they found is that really all of those behaviors had a very limited effect on mitigating this major financial shocks. Which, raises the question, are these then, what's sort of the evidence again of the need for a safety net? And one of the things that they did find these behaviors matter was actually in reducing the probability of those events to occur. And so that made sense. So a lot of the people who planned ahead were less likely to have a problem of losing a job. So it was more related with the actual incidence of the event rather than the ability to sort of mitigate the negative effect on financial well-being. Lastly, I just sort of, because I mentioned incidentally the sort of the fact that these are related to COVID experiences, right before the first month of the pandemic, the University of Southern California ran a survey on where they asked people, what are the chances that you may experience any of the following? And they had the score for the individuals either up to January of 2020. And so we are looking here, what's the relationship of the score that those individuals had in file at that point with what they said was their probability of experiencing any of the following. And as you can see, the health-related chances are not related. All of these are statistically significant from a sort of Pearson coefficient standpoint, but like the level of relationship, the strongest one between financial well-being is with the chance of running out of money, which makes sense. And then the second one, as you can see, is the chance of running out of money with the chance of losing a job, which makes sense. You can probably see one of 0.64. That's the chance of being quarantined and the chance of getting the virus. And again, that makes sense that you will have those two will be extremely associated. But again, we do find a strong relationship between those two, and currently we're studying to what extent individuals' financial being at the moment of the recession predicted a lot of the financial experiences that they had through the pandemic. Again, this is only March of 2020. Many states had not gone through lockdowns or any type of social distancing rules or furlough individuals. So the assessments at this point were basically capturing that month. So we are collecting a lot of data, have collected a lot of data. We're still analyzing it, and we hope to sort of share that with the group as it comes out. I just want to say that there are several public data sets that have the financial being scale. The Federal Reserve Survey of Household Economics field did it in 2017 and now in 2020, and that will be forthcoming this year. The University of Southern California has been conducting the scale since 2017. It's a longitudinal panel, so you can see the individuals' changes through 2020, and they're still collecting it. The HRS included it in their 2020 survey. And we have the survey at the Bureau of the 2016 Financial Wellbeing Survey. Other people have done it in proprietary data sets. And if you're interested in a particular topic, I will be able probably to connect you with those individuals. Again, I just want to thank all of you. And I know we have a couple of some time for questions now. And here's a link to where you will find, again, the scale, but also links to a lot of the research and work that we have done around financial well-being. So again, thank you again, and I just looking forward to your questions.
We did have a question from David Nixon earlier. I think it was in the first section, but David says, I was struck by how far up the distribution substantial numbers of people said they did not have enough to eat. Do you have any thoughts on this?
Yeah, I mean, we have seen it in the news, like the long lines of people going to food banks. We do have a level of insecurity that even in higher levels you experience that. As I sort of was thinking about that statement that I made about how two individuals could arrive at the same location through two very similar sort of paths. I mean, you can think of older adults or people who are just also like sort of engaging in certain high frugal behaviors in order to meet certain goals, and yet they are sort of compromising some of those sort of basic financial material hardship items. So there are situations like that too. So you could have someone here like a college student, and yet they have, again, a perception of a bright future. And so that is one of the sort of the difficulties of the scale, unless you actually look at those specific individuals and you can sort of mine the specific answers to those questions. You could see, why, for instance, you will have someone in a slightly higher level of financial being who are still saying that they have material hardship, but generally that basic material hardship at the lowest level, that makes sense. I mean, that we expect that from someone in the lowest level of financial well-being.
Thank you, Hector. I have another question. So what have you learned about the role of Social Security or the safety net and people's financial well-being?
So certainly, so we had a question about Social Security in our original survey, and one of the things that you see is, pretty much Social Security acts as a it's everyone after 62. There's the percentage of people with it. Everyone have it. So the sort of working out Social Security as a predictor of well-being for the 62 and older, you just don't get more, you don't get a lot of information about that. You get it when you actually look at how the patterns of well-being change by age. And so there are two very distinctive points where like there's a big jump in the value, and one of it is from age 61 to 62. And then the second one is at age 65. And those two, we know what happens at those two ages. The other distinctive thing about it is that if we look at the financial well-being scores of people, depending on when they claim Social Security, it aligns with what we have always been saying. If you take your full Social Security or above, you are better off. And so we ask people, when did you claim Social Security? And of course, that's also, there's other factors that explain why people claim later, but generally, those who maximize that source of income are better off. But what we cannot we can see in the data, that goes back to this issue of age. The financial well-being, even for the vulnerable groups, as they age, increase, and particularly at age 62. So at least Social Security is creating a floor. If you look at the percentage of people in the two lowest categories, the low and very low financial well-being, for the 62 plus population, it's only 6%. For the general population, is 11%. So it's a little bit higher for the only 18 and 61. So Social Security certainly is creating a floor that is protecting people on the two lowest ends, end of the distribution. I want to invite people not to only think of the lowest segments. I know that those are the vulnerable ones. They're the ones that need attention. I want people to also think about the highest segments, not because of who's there, but because the highest segment in our data pretty much indicate that those individuals are fully financially secure. These are the people who don't have to worry about anything. And the fact that we have such a small percentage there, and the fact that that's where we see a lot of the gaps. That's an important sort of category to examine. So it's not just simply in the lowest end. In the lowest end, what we are finding is that cultural factors sometimes matter, safety net of family and friends matter, and sometimes you don't see the differences that we may expect to see if compared to, for instance, if we were just looking at income or wealth.
And what does your research tell us about how to respond to the financial challenges brought by COVID-19? And what does the future look like in terms of, next steps or the direction we're going in terms of these challenges that have been brought on by it?
Oh, absolutely. So I think, it's interesting. The question like this sort of comes up in our agency as we sort of look at sort of the response. And I'll say, we showed already just with that longitudinal data prior to the recession that job-related losses are very related, are the strongest predictor. And by the way, that was just our study. The University of WashU had its own sample with low income. They found that employment was the strongest predictor of, again, a change in financial well-being. And the most vulnerable were self-employed individuals. And that, again, makes sense because many of them, the protections, if they were to lose their source of income, are not the same as if you're employed, and insurance, employment insurance sort of kicks in. The the message, sort of, for instance, for our agency has been around, we need to be sure that people get access to the unemployment benefits. Particularly in our agency, we deal with banks, so ensuring that banks are not that there are no barriers to accessing those. If those are given on a card to the individual, like many states do, that banks are complying with that. And so if you hear about problems of people having those issues, let us know. That's our role as a regulator. And the other thing is that we know that unemployment insurance, for some people, it turned out to be great with the enhanced benefits, but we know for a significant portion it doesn't cover the entirety of their needs. But for them, forbearance on student loans and mortgages are making a big difference. And so that's the second area of work that the agency is sort of targeting. That we are also very interested in housing. One of the strongest relationships in the data is between housing burden and financial well-being. And so ensuring that, we know that houses are valuable. And all of us who have been either with kids at home and working from home, it's your daycare, it's your school, it's everything. And so ensuring that Americans are not evicted, ensuring that Americans are, able to stay in their homes, that again, a mortgage payment is not a barrier to that. So those are two areas that we are sort of targeting as urgent areas, but certainly the future of this research, a lot of it is on recovery and how do we ensure that as we recover, it's a more equitable recovery, and that we understand some of the drivers of the differences that we see here. Because some of these differences by age could be life cycle, and they could be generational. It could be that, among the younger Americans, we may not see, as they age, we may not see such stark differences as we're seeing from previous generations.
So a couple more questions, Hector. Given the large average differences in income and wealth by race, why do you think you find relatively small differences in subjective financial health, assuming I'm interpreting your data correctly?
Yeah, no, that's the question that I get a lot. There's a few things that I want to sort of say about that. Certainly that again brings us, let's look beyond the average. And that's when I'd say the most important things to look at are those percentiles, the 90th and 10th, and also that high group. What percentage of people are in that group that is either high or very high? And there you could see a 10+ % difference between white and group and people of color, like particularly between white and Black and Hispanics. That's where you're going to see the big difference. And again, the highest level is where you see the full the full experience of security, of not having to worry about a variety of hardships. At the lowest level, there's so many explanations. I'm just in the process of working on, particularly on a paper on financial well-being of Hispanics. And what we find is at the lowest level, again, despite incomes being different and wealth being different, at the lowest levels of financial well-being, the same percentage of Hispanics report low and very low as Blacks and whites. And there are, and I sometimes anecdotes are part of how we think of hypothesis. I have a family. My family is primarily from Puerto Rico. They probably make multiple less of what I probably make in DC, and they're much more satisfied. But part of it is they have different expectations, but they also have significantly different liabilities. They're not concerned about the same kinds of things that I have. Their finances are also much simpler. And in that sense, again, they have a safety net that is different. They help each other build their homes in some cases, so they don't have a mortgage. So there are many things that culturally explain some of these things too, that we may not be, that of course income and wealth itself doesn't say anything about it. And I think this measure captures other dimensions. I'm not, again, I think it's important to keep looking at wealth and income, because those are two large predictors of how people feel about their financial well-being. But again, there are many other things. We know people who have a lot of income, and yet, they're either, because of health or because of liabilities or expense or behavioral issues, they're not experiencing financial well-being.
And final question with our last couple of minutes. Just a question comment, I guess. Don't we have a unique opportunity to revalue assets with financial markets temporarily disconnected to reality with the COVID pause?
Could the person sort of restate the question in a way that that I may sort of be able to connect with sort of the financial well-being?
Michael, do you want to unmute and ask your question?
Sure.
Yeah, the stock markets, we don't have to have a recession, because the stock markets aren't directly connected with reality and the prices. And so we could actually have a negotiation while we're in a pause situation where, well, for example, fossil fuels are more valuable to humanity left in the ground than they are taken out for any reason. And seems like we have a pretty phenomenal opportunity to have a transparent discussion with little risk of economic depression or war, because there's no military solution to the COVID problem. So we could actually shift budgets, without downside risk. And I was just thinking of that as a very, very unique opportunity for financial and social experimentation.
Yeah, I mean, I think that's the point, that there's a disconnect between different measures of what people keep sort of an eye. It's interesting, and that was one of the things that our agency was expecting from this particular scale, was to serve as and score to sort of serve as an indicator that was distinctive from the market type of indicators, including the stock market. And I think you're right that there's a value in a measure like this, because in particularly during this time, because one of the things that it's telling us is, even from talking to people, it's that that there are things that people value in their lives, and their finances are good to the point that it provides them to do so. And certainly for a lot of Americans, it doesn't. For a lot of Americans, their finances is not just that simply. I mean, it's important that they're experiencing material hardship, that they cannot pay for their rent, but there's a large segment of this country too, that even though they're able to meet all of that, they're just not happy with what they have. And so I always tell, when I talk about this scale to financial coaches and professionals that do education, I don't sell it from the perspective of, here you have an economic indicator. I sell it as this matters individually to people. Like, they're not going to engage in a behavior if whatever you're teaching them doesn't have a positive outcome on them, and then they internalize it in their satisfaction and well-being. And also, you cannot ask people to always be sacrificing. Like, it was always a reminder around the issue of savings. Like, it's like sort of like, be extremely frugal. And people want to have dinner, people want to be able to provide a gift, and those are meaningful things, and people find joy in that. And so it's, for what it's worth, the fact that we're able to measure that, and we're able to measure it in a reliable, valid way, I hope it can shift some of the conversations around what is a true measure of well-being, and an important measure to track over time.
Thank you so much, Hector, and thank you to the Consumer Financial Protection Bureau for hosting this. And for the participants, please know that you will be receiving a follow-up email with the survey after this, and we look forward to seeing folks tomorrow. We're kicking off at 11 a.m. Have a great rest of your day.
Thank you, everyone. Appreciate it.